So I did not buy this stock because volume did not come. This stock came on my radar on the close of 15th October candle. So let me put this here. So I saw this stock as this candle closed, and that got me excited because I saw tight price action here. See, if I convert this to bar chart, look how tight price action is there. Okay, so that got me excited. I looked at the stock. So first, let us try to understand why was I interested in this stock? Why did I put it on my buy list? And then we will try to understand why did I not buy the stock, okay, as it broke the yellow line. So, number one, is the stock in an uptrend? Yes, the price is above the 50-day moving average. The 50-day is above the 150-day, and the 150-day is above the 200-day simple moving average. So that is a stage 2 uptrend. That is our basic condition. Second, are there minimum 10 candles in the base? Yes. So this is point one. So I start counting from here. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So there are minimum 10 candles in the base. Are there minimum 4 points in the base? Yes. So I join the points. So this is point one. That's point two. Somewhere here is point three, point four, point five, point six. Now this got me excited because whenever there are more than 4 points or whenever there are 6 points in the base, and if the buy point is in the blue zone, that is acceptable to me. Or in other words, if the buy point is in the blue zone and there are 6 points in the base, that excites me because you have a lot of contraction coming in. If the buy point is in the green zone, I am okay with only 4 points in the base. But if the buy point comes in the blue zone, I expect more contraction. So this has got 6 points, 3 contractions. So point number 5, which is 910, becomes the buy point. So let me remove this. By the way, for those of you who don't know, the green zone is the top quarter of the base. The blue zone is the second quarter of the base. And the red zone is the lower half, which is the third and the fourth quarter of the base. And if you see here, step one for any breakout strategy, step one is a high volume rally. So this is a high volume rally. Look at the volume here. Step two is a low volume consolidation. See, low volume consolidation. And step three is a high volume breakout. So step one and step two is already completed here. Now we are waiting for step three to come, okay, which is a high volume breakout. And I have already marked my buy point. So 910 is the buy point. So normally what I do is I don't want to buy a stock which is extended. So if the price goes up more than 1% above the buy point, I'm not buying the stock. So if you look at this, 1% of 910 is 9 rupees. Okay. So you add 9 to this. So around 920. Okay. So you draw a line at 920. So this is the range in which if the stock begins to break out on high volume, those are the two yellow lines in between which I want to make my purchase. So if I want to buy, let's say 200 shares or 500 shares of the stock, then the moment it breaches this yellow line and enters that zone between the two yellow line, I will buy 100 shares quickly. Then as I see more price and volume action, I will buy another 100. Then as I see more volume and price action, I will buy another 100. All of this will happen within a time span of 2 or 3 minutes because I'm carefully watching price and volume. However, if I buy the first 100 shares and if the volume is coming in but the price is not showing the follow through, then I will not buy the next lot of 100 shares. So if my plan is to accumulate 500 shares, then my goal is to accumulate all the 500 shares inside that yellow zone, the gap between the two yellow lines, which is a 1% gap, because I don't want to buy a stock that is extended. So if you see this on the 15-minute chart, that gap looks larger. See, now you have sufficient cushion. So when the price enters this zone, Okay, as long as the price remains in this zone, you could quickly start making your purchases, and you can check volume coming in here. You can see follow through of price action. You can see volume coming in supporting that price action. So you quickly place your orders instead of putting an automatic buy order. For that, you need to place an alert, a mobile alert. You need to place an alert somewhere, like if it is 910, put your alert at 908 or 905 so that your mobile phone alerts you, and then you can come in front of your laptop or your desktop, and as the price enters that yellow color zone, you could start making your purchases. Okay, that's trade execution. This is what I was planning to do. I remember I was still not involved in the stock. However, look what happened. The next day, the price touched the yellow line and briefly entered that yellow zone, the zone between the two yellow lines. So that gave me a signal to buy. However, look at the volume. This is the daily time frame. Look at the volume on the daily time frame. This is the closing volume. If the closing volume itself is below the blue line, imagine what the volume would have been on the 15-minute chart. Yes, on the 15-minute chart, I saw volume coming in, but I did not see follow through price action. So let's go to 16th of October. Yeah, this one. No, wait, let me remove this. So on this day, I was planning to buy the stock expecting high volume, but that did not come. So let's go to 15-minute chart of 16th October. Okay. 16th October. So this is the first candle of the day, low volume. This is the second candle of the day. Again, not great volume. Third candle of the day. Again, not great volume. Now you have good volume. So 4,000 shares traded, and the volume is twice the average volume. Average is the 50 period simple moving average. However, you see on this candle, I was waiting for the price to close above the yellow line. See, it enters the yellow zone, the distance between the two yellow lines. So the moment this happened, I was planning to buy, but I looked at the daily time frame chart. On the daily time frame chart, if you notice, this is an extremely low volume stock. So what's the average volume? This 232,000 shares. It's not like millions of shares are traded per day. For this stock, high volume is something like 201.6 million, 1.2.5 million, okay, 2.155 million. That's high volume for this stock. But on 16th of October, this only 11,000 shares traded. So although it shows good volume on the 15-minute chart, but I said, okay, let me wait for that candle to complete. Okay. Ideally, I should have bought it immediately as it entered above this yellow line. Ideally, that is what I do. But for this stock, especially since the average daily volume is less than 500,000 or less than 1 million, it's a low volume stock basically. So in a low volume stock, coming 11,000 shares traded on a 15-minute time frame chart is not huge. You could take some time, give the stock some time, give it 15 minutes and see. And you see there is no follow through. Not a single candle during this day has closed above the yellow line. So that is why I did not buy the stock. So in this video, I have done a purely technical discussion of trade execution. I have not yet discussed the uh, ratings or why I was considering the stock in the first place. Let us have a quick look at that so that you understand what caught my interest. So let's go to Stuff Craft. That's the name of the company. So Stuff Craft. The moment I saw the stock, I knew that this is not going to be a positional trade. This is going to be a swing trade. So in swing trading, you hold the stock for a much smaller period of time. Now, have a look at this. Earnings, June quarter, 0% growth. Earnings have Sales have grown by 6%, but last quarter it was 17%. So sales are declining, earnings per share is declining, and you look at the earnings per share growth rate, multiple red colors here, which means uh, on a quarterly basis, the earnings have been declining by huge amounts. Okay. Not many funds are holding on to the stock. That is another negative point. Okay. I don't see any negatives here. Good master score, good EPS rating, good price strength, good institutional demand, group rank is fine. So I don't see any problem in this particular area. I see a problem here. So fundamentals of the company are weak. See how many quarters out of these many quarters, see how many red colors. Red colors means deceleration. Okay. That is not convincing. If the earnings growth is 144% in March quarter and 0% in June quarter, that's very erratic. It's not consistent. It's not stable. Compare this with Triveni Tribune, okay? Triveni Turbine. Look at this. Then you will see the difference. Look at this, all blue color, all blue color. Okay, now you see the difference between two companies. Blue means positive, red means negative. So can you see the difference now? The earnings growth is consistent in Triveni, but in Kraft, you see disaster. Okay. Yeah. So not convincing quarterly earnings chart. That was a concern. So immediately when I looked at this table, I knew that this is not going to be a positional trade. If at all I buy the stock, it is going to be a swing trade. So if I am taking a swing trade, then I need to be extra cautious. Extra cautious means uh, I need to get price confirmation and volume confirmation on the smaller time frame chart before I take the entry. And especially for this stock, because there are stocks where the average daily volume is 1 million shares traded minimum. But for this stock, you only have 232,000 shares traded per day on an average. So it is not a high volume stock. Plus, it is a small cap stock, only 2000, only 3,000 crore market cap. Sales is only 1,300 crore. So value wise also, this stock is a small, it's a very small company compared to the rest of the stock market. It is low volume, it is not very liquid, although it meets my criteria, but comparatively on a relative basis, it's a very low volume stock. There is good tight price action on the right side, but I want confirmation. And as you can see, there was no confirmation on 16th October nor on 17th of October. Okay. Now, does that mean the stock has failed? No. The stage two uptrend is still intact. The price could still consolidate on the right side. If you see good 3, 4 candles closing in the green zone, I might want to re-enter that the stock. If the price enters the green zone and you see good volume coming in, price also supporting good volume, I might take an entry into the stock, but not with a huge position size, maybe 5%. Okay. Less than 10% for a swing trade, especially if the stock does not have good fundamentals. Now, the question is, if the stock doesn't have great fundamentals, why is it going up? Well, that's where we say markets are supreme. The markets know something that we don't know. Okay. So let the market confirm our opinion. If that is happening, we take an entry into the stock. And if there is truly some problem with the company, truly some problem with the stock will naturally come down. It will never come to our buy price. And even if it comes to our buy price, it might not show great volume. Okay. And if it shows great volume, we are entering. And after we buy, if it doesn't give us follow through candles on the lower time frame charts or on the daily charts, we will be quick to exit. We will not wait for the price to go down completely and hit our 7 to 8% of stop loss. We are not going to give that much time to a stock which does not give you fundamentals. So now you understand how I approached this stock. Mentally, I was clear that this is a swing trade. This is not going to be a positional trade, which means my risk is high because of swing trading. Second, fundamentals are weak, my risk is even higher. Third, volume is poor on the stock overall, so my risk is higher. Fourth, it's a small cap company, not a huge business, so again my risk is high. So when all the factors are telling me that my risk is on a higher side, why should I take why should I give the stock more time? Why not wait on the 15-minute chart till the candle actually closes above the yellow line? I might not do the same thing on a stock which has got 1 million shares traded volume, because that institutions are doing some buying there. Okay. So I might not do the same thing that I did on the stock on some other high volume stock which has got good fundamentals. I might give it some time. Even after I buy, if the stock comes down, I might give it some time. I might reduce my position size. But in this case, I did not buy the stock at all. Okay, not even a single share, because I did not get confirmation. See, the yellow line and all this technical and fundamental analysis is all just our opinion. Okay, it's nothing. It's not a fact. It's just our opinion. Now the market has to confirm our opinion with price and volume action. Unless that happens, we are not going to risk our money. And by the way, this is the moral of the story of the first chapter of Jesse Livermore's book, How to Trade Stocks, which was written in 1937. So back in 1937, which was almost 100 years ago, Jesse Livermore has already declared that unless you get price and volume confirmation, do not buy the stock. Okay. So if 100 years ago somebody has already figured out this concept, why should I risk my money in a stock which is showing me risk all around? Okay. So I hope you understood the logic as to why it came on my radar, why I was interested, and why I ultimately ended up rejecting the stock on the breakout day. Okay. So I hope this video has added value to your overall trading journey. I hope you learned from this. Rejecting stocks is a far more important skill than selecting stocks. Your trading performance is more a function of how many stocks you reject as opposed to how many stocks you select. Always remember that. Okay. So please support this YouTube channel. Already you have been supporting this channel since past 2 3 months. The channel is getting a good response. So please like, comment, and share this video with friends, family, and business associates so that they can also learn with you. And this video, most importantly, this video should reach that person who genuinely wants to become a professional stock trader and who does not have the money, to buy courses and all those things. YouTube is more than enough resource to start learning. So if you like, share, and comment, you are indirectly helping others. Okay. So thank you so much for all your support. Thank you so much for your time that you're giving me on this content. Take care.